We're going to go over the accounting for receivables, the allowance for uncollectible accounts overview of the different methods available to accountants to handle bad debt when their customers are not paying them. So bad debt expense, what is it? It's the inherent cost of granting credit. It's considered an operating expense, or it's handled as an operating expense incurred to boost sales. And it does follow the matching principle if it's handled using the allowance method, because you match the estimated expense in the period of the sale. And you want your accounts receivable to be valued correctly, and that is known as your net realizable value, not necessarily the full amount that's in the accounts receivable, because some of it you may never collect. When you're looking at net realizable value, you're thinking about what realistically can be collected, and that's how you want your accounts receivable, this asset, valued on your balance sheet. So with just a basic review or basic introduction, there's the direct write-off method, which is allowed, and then there's the allowance method. Now the direct write-off method, it is allowed, but technically it's not GAAP because it does not follow the matching principle. It's allowed if the amounts are not material. The allowance method technically is required by GAAP, and there are two main approaches, two ways to calculate it. One is considered the income statement approach, and the other is the balance sheet approach. So we're going to focus on the allowance method because that's really what companies should be using. With the income statement approach, remember, it is an estimate. It is best, or thought to be best, from the matching standpoint, but it really is hardest to estimate exactly. The balance sheet approach, and there's two different ways to calculate the balance sheet approach. It is also an estimate. This, instead of focusing on the income statement, is focusing on the balance sheet. So I'm more concerned, if I'm choosing this method, on the valuation of my assets and finding out or calculating what that net realizable value really is. With the income statement approach, it's simply a percentage of sales, and it's very easy calculation. With the balance sheet approach, it can be the percentage of accounts receivable, or what's thought to be more accurate is the aging of accounts receivable, because the older or more delinquent your customer accounts get, the less probability they will ever pay you. Income statement approach, it is an easy one-step approach. Balance sheet, you can think of this as a two-step approach because you kind of have to back into it as opposed to the one step and you're done. Either way, the allowance for uncollectible accounts, this is a contra asset, so it will have a normal balance of a credit. It is a permanent account, so you will have a beginning balance. If you write something off, it will decrease the account because this is the account you use to write off delinquent accounts. You set it up at the end of the year. To follow the matching principle, you want to record that in the year of the sale, and then in the following year or years, you use the allowance that you set up to record the actual write-offs. That way, the bad debt expense is recorded in the same year as the revenue from the accounts receivable sale. When you do record bad debt expense, this is what will increase the allowance account, and again, it's a permanent account. So either method, the income statement approach or the balance sheet approach, will have an ending balance which goes on the balance sheet, and of course the bad debt expense goes on the income statement. So how do you do it? One step and you're done. Companies will decide what percentage of sales, total sales, or sometimes they just look at credit sales. What is the percentage they think will not be collected? You simply multiply your sales by that percentage, you record bad debt expense, and that goes on your income statement. For the balance sheet approach, if you look at a percentage of accounts receivable, you want to know what the value of your accounts receivable will be. So you're thinking about your ending balance, but that is not bad debt expense. Step 2 is to back into that bad debt expense.